Portfolio Builder members, welcome to our October 21st Monday Trade Alert, where we play the SPY ETF. Today we'll take a look at the current trade alert, how it fared, and what our plans are for the rest of the month leading up to this ever so critical trade deal phase 1, which caught the bond market completely off guard last Friday. So if we do take a look at the returns, we can check out the Friday trade. And I'm going back 2 weeks ago to when we had the surprise trade announcement. Last Friday, our trade alert was to sell the 350 call and to buy the 297.50 put. And this is when the SPY was trading at 298.77. You can see up in this quarter. And we paid a debit of 24 cents to apply this option caller to the trade. Today, as of closing it, the SPY traded higher to 299.71 for a gain of 94 cents. Our option caller required 6 cents to close, bringing a loss on the options to 30 cents. The net profit is 64 cents a share. In our model portfolio, that is 1,700 shares, or a profit of $1,088 over the weekend. The key news is that trade talks remain positive. ECB is buying $20 billion a month of their government bonds, and the Fed is purchasing $60 billion a month, primarily in the short end treasuries. Rate cuts are still expected at the end of the month, and many S&P 500 companies are reporting earnings this week. Here's our current asset allocation recommendation. Per $75,000 in your portfolio, we are weighted 48% in equities, slightly heavy in equities, 40% in bonds. Again, the bonds are critical to our strategy, and as I'll show you in a moment, we have to have them in our portfolio to protect against downside risks in the equities market. In fact, the bond portfolio has delivered profits in 9 out of the last 11 months, and I believe will continue to do so. And then furthermore, we have a 12% position in gold, not the spot gold, but we're playing gold miners, GDX. And our target income is $750 a month per $75,000 invested. However, we've averaged closer to $1,000 a month profit per 75K. And so the breakdown on this is that we trade 100 shares of the SPY Monday, Wednesday, Friday, taking advantage of 3 option expirations per week, 200 shares of emerging markets, that's the EEM ETF that gives you exposure to companies like Tencent and Alibaba, and then we have 200 shares of the TLT, which we're trading on Thursday. Now, the TLT has been the big money maker and continues to provide downside protection to have this heavier equity position in the SPY. And if we scroll down a little bit in the trade alert, you can see our average return is just under 1.5% a month over the past 11 months. Our current return in October is down 0.7%. And this is after having one of our best starts to October, where we are up 1.1% primarily from the TLT. So we'll take a look at why this does not bother us and what our plans are going forward. But there's a lot of factors that could cause the TLT to spike back up, so we don't want to freak out and ditch our TLT shares. In fact, that's the last thing we want to do when we look at the grand scheme of things. Now, I want to point out what our return looks like over time and how our service has become so popular. And it's because we're able to protect capital in times of sell-offs in the equities market. And most people who join this service typically have a huge allocation, if not 100% allocation, into equities. So they see their drawdown swing 5-10% every several months when the stock market has a little fit. And so if we look at our returns, because of this overlap of stocks to bonds, we're able to normalize your returns and take away these big periods of loss. So in December, when the S&P 500 went from a peak of 6% up to a drop of 12%, so that's almost an 18% drop from the top to the bottom, we squeaked out a 1% return. Come January, we did not outperform the SPY, not by any stretch, but what did we do? We delivered a 2.2% return. February, the SPY continued to travel higher. We made 1.7% return. In March, the S&P 500 was pretty much flat, jumping up and down. We returned 2.7%. Now, here's where our results really stand out and why people really are gravitated to this strategy. April, 1.2%, sure, S&P 500 outperformed. But what happened in May? In May, we had a massive sell-off with a peak drawdown from the top of May towards the beginning of June. We saw the S&P 500 collapse 7%. We made 2.2%. In June, we made the best profit of the year, 3.2%. Again, we did not outperform the SPY, but we're not trying to. What's important here is we're trying to not have substantial losses in almost all outcomes for the market. Now in July, we had a negative 1% return, and that's the same reason we have a small drawdown right now. In July, I was fearful that the talks at the G20 meeting would fail and that Trump would raise tariffs and escalate trade tensions. We were wrong. They came out saying they're going to have a great deal, and we lost 1%. And that so far is the only month that's closed out with a loss to date. Come August, guess what happened? Trump announced new tariffs. The market sold off. In fact, if you look at the return in the S&P 500, it dropped as much as 6%. What happened at our portfolio? We ended up with a 1.8% return. Now in September, we had a almost flat month, only 30 basis point return. And so far in October, it's been quite a wild swing. We started off with the 1.1% return, primarily from a rally in the TLT, only to have the surprise trade deal come out last Friday where they're going to do this bogus phase one deal to get agricultural products. And again, I had been predicting that is exactly what had a high likelihood of actually being accomplished this year, was that we could potentially get a farm deal in exchange for delayed tariffs and most likely some sort of easing on their national champion, Huawei. But leading up to that Friday event, everything was happening in the wrong direction for us to predict that outcome. China was buying lots of agricultural products, but what was the U.S. doing? They were sanctioning 18 Chinese companies. They were doing all kinds of nasty things. So in fact, in the last month or two, Trump has been at the United Nations down-talking China and a host of other reasons to be scared last Friday when that outcome came out and shocked the bond market. So again, I'm not worried about the TLT. We remain long. And the reason we're able to generate these profits, even when the stock market does pull back, is because of that TLT position. So we'll take a closer look at the relationship between the SPY and the TLT in this video. Let's just take a look at the new trade alert. And again, for those paid members, we have figured out a solution so none of the freebie seekers get to see our content until the market's closed. Don't worry, no one's stealing our content here. So here is the new trade alert: sell to open the 301 call and buy to open the 297 put. So we're collecting 47 cents from selling the call option and give up potential profits after 301. And on the same note, we are protecting it against downside risks by owning the long put at 297. So the worst case scenario for us is we'll walk away with 297 a share, and the put option writer gets to keep our 27 cents. But keep in mind, if that were to happen and the SPY were to tank, not only would our TLT shares fly up, not only would our gold shares fly up, we would generate a large profit on this 301 call option, which essentially will more than pay for the cost of our put. Here's a look at the risk to reward ratio. And you can see we can generate a maximum profit of $1.46 per share, which is a lot bigger than we're actually trying to average in the long run. If we just average 25 cents a share 3 times a week, 52 weeks a year, then we're averaging a 1% return per month. So this is substantially higher potential profit than we need to hit our targets. On the downside, our maximum risk is $2.53 per share. Okay, so that's a quick look at what our trade setup is today. Let's take a quick look at a few other things. This is a few slides from our boot camp that I wanted to share with everyone. And so the general strategy we have is to try to predict the long-term macro view and then play that direction almost religiously despite what the short-term volatility is doing. So if we just chase the S&P 500 every day in the direction it went the last 24 hours, that's not the strategy we're recommending here. Instead, we're trying to get the big picture correct and then slowly but surely generate profits by having a high probability and a high win rate with very limited downside risks. So number one thing I'm always tracking is whether the Fed is buying or selling. If they are buying, that is very bullish for the markets. And you can see much of this rally has been created from the Fed buying up treasuries. In fact, in the last 6 weeks, they've purchased $200 billion of treasuries. Now, mostly in the front end of the curve. So they're trying to straighten that yield curve out and make it more profitable for banks because with an inverted yield curve, it messes up their whole strategy of lending money at a lower rate than they can borrow. So in the current environment, the Fed is buying and the ECB is buying. Next thing we want to know is the Fed lowering or raising interest rates. And at this point in time, they're lowering interest rates. In fact, in October, I expect they will drop rates by 25 basis points. And if we don't have some sort of trade deal signed by mid-November, they may very likely drop rates even more dramatically in December if these tariffs go up. In fact, if that happens, I think they might drop rates by 50 basis points because that would certainly cause a massive stock crash if they don't come up with this phase one deal. And so the third thing I like to track, of course, is inflation rising, and if so, at what speed? Because that's the only thing the Fed will actually react to increase interest rates. And so here's what I suspect will be our portfolio allocation for the next period of time until either the trade war breaks down or inflation starts to pick up. So right now, I believe we will have a period of lowering interest rates, which we've already seen 80% of central banks begin the process, with the Fed jumping in after everyone. We're in a period of low inflation, and we're also in a period of quantitative easing. Now, normally, you don't get all of this until after a major stock market crash. But this time around, they're using the alibi that the global growth is scaring the Fed to create an insurance cut and insurance quantitative easing. So our current strategy is to be long stocks, primarily with the SPY and emerging markets, but to have the TLT as our buffer, because if they're lowering interest rates and the Fed is supporting the bond market, we have limited downside on the TLT. But yet, if there is some sort of shock to the equity markets, the TLT plays a pivotal part in our strategy to generate profits. What comes next? If you listen to Ray Dalio, most likely rising inflation while we do this quantitative easing. And that's what's going to put an end to this party. Now, could a U.S.-China trade war escalating expedite a stock market crash? Sure. But until those trade talks break down, I don't want to be betting against equities, not when we have all the factors headed the right direction for equities. But what could happen in the near future, maybe around 2021, 2022, is the inflation figures start to pick up. And if you print enough money and it starts to escape out of the financial systems that it's just been circulating in, that's when you might start to see some serious inflation. And the Fed's response to that will be to end QE and to jack up interest rates. So leading into that period, we would still be long the SPY, but this will be most likely at nose-bleeding levels. So I'm thinking the SPY will trade between 315 and 330 if they can pull off a phase one trade deal. So we have a potential 5 to 10% return in the SPY. On the emerging markets, just to get back to recent highs, we have a potential 20% gain headed our way. Now, if they start to see inflation and there's the fear of rate hikes, then we want to be short the bond market. So we can do that with our upside down or inverted option collar and remain long the stocks, silver, and gold until they actually start hiking up rates. And you can see this would take a considerable amount of our money out of the equities portfolio and goes to a heavier gold and silver position. Finally, and this is what Jeffrey Gundlach has been predicting, and again, these are the key people I follow for trading strategy, primarily by looking at their 13F filings. We got Stanley Druckenmiller, we've got Ray Dalio, we have Jeffrey Gundlach, and the last slide will be Buffett. We'll talk about when would the Buffett play and strategy really come into play. So after we get rising rates from inflation fears, or actual inflation in the CPI, that's when we would finally want to get short equities and be long bonds and the dollar. So this is what I see coming potentially in 2022 through 2027. If you listen to Ray Dalio, a lot of these guys, they're expecting a long period of slow growth and recession/depression as the world has to work off $288 trillion of debt it's created. Finally, you get to the end of the opposite of this cycle. Look at the period of 1980 through 2000, one of the longest stock market rallies of all time. And you get dropping rates and the expectation of potential QE. So this may not come into play until potentially a decade from now, as we have to reset all these global instruments. But this is where we would go to a heavy equity bond strategy, where we'd be swapping out the SPY for the QQQ. We'd swap out the TLT for LQD and buy us some of Buffett's favorite stock, Apple. So this is sort of what I expect as the most likely outcome in the markets over the next 10 years. And this is going to primarily be from the central banks doing what they always do best, printing too much money. Now, just a quick review of how we can profit from these different scenarios. Even if the underlying asset goes up or down, we have 3 setups for our option callers. It's all you'll need to know to follow our strategy. So bullish, we use a loose options collar, and you can see we're selling the 301 call and buying the 295 put, and you actually can't see the price, but the price is right in the middle. So this gives us the opportunity to generate a $290 profit if the SPY were to travel higher, but in the same breath, the opportunity to lose $310 if the SPY were to travel lower. Then we have a neutral tight options collar, and excuse the typo up top, I'm still finishing all these slides. You can see in this setup, we tighten up the option collar and can actually profit if the market goes flat, down, or up, but the profit is much less. So in this setup, when we tighten the collar, we have a maximum profit of $93 and a maximum risk of $106. So this is the type of trade we'll be doing when we think the SPY is not ready to sell off, but we think it may trade flat. So this is somewhat like we have in our trade setup currently. As we bump into the 302 to 305 level, we'll be doing a trade just like this until we get some positive news on the trade front. And then we have the bearish inverted options caller. And this is where we sell a call option that's below the trading price and buy a put option that's above. And this sets us up to actually generate much larger profits betting down on the SPY. And we own 100 shares of the SPY. We sell a very juicy call option where you can see we're collecting, in this example, $219 per contract, and then buying an even more valuable put option. So we can actually generate a profit with very low risk by owning the SPY, selling that in-the-money call, and then buying the in-the-money put. So those are our three setups that we can use to ensure we can profit in each market environment and each direction that we're predicting for the long haul. Now in this chart, I want to point out something very important about our strategy. And on the top line, we have the S&P 500. Clearly, there's more money to be potentially made in equities, but there's also a whole lot more volatility. And so in this chart, what I want you to see is the orange line below is the TLT, where the green and red line above is the SPY. And so what you want to notice is every time the S&P 500 sells off dramatically, the TLT spikes up rapidly. And it's this relationship that makes our strategy so strong. And here's a look at the TLT once again. You can see it's gradually been increasing in value, but the primary purpose in our portfolio is to protect against downside risks in the SPY. Here's a few closer examples. You can see in the orange line when the S&P 500 crashed as much as 50%, the TLT rose as much as 38%. So it didn't completely offset the exact losses in the SPY, but did a good job masking almost all of it. And if you had been seeing that the rates were rising during that period and inflation was increasing, we would have been in a setup that's heavier in the bonds. So that would actually have worked out great. Here's another example just showing the relationship between the SPY and the TLT. And you can see when one goes up, the other goes down. But in general, they're both moving up together in an environment where we have lowering interest rates and quantitative easing. Once again, you can see in this period of time when we had a strong bull market in equities, the TLT position, had you placed a large position in it, would have only given you small amounts of drawdown while providing tremendous amounts of protection to your portfolio. All right, guys, let's take a look at our live stream content. Here's a look at the top stocks I'm following. Most everything was up today. The TLT continues to be battered, but again, we want to have that position as it provides the protection to our portfolio for unexpected surprises. And if you're wondering how we walk away with nice profits in periods like May when the S&P 500 tanked 7%, well, the secret is that our losses get cut off pretty quickly on the SPY because of the put, but then the TLT has room to rally significantly. And that's typically when we're generating these larger than expected profits, is from unexpected sell-offs in the stock market. Here's a look at the SPY. Again, my forecast is we can get into the 315 to 330 range by the end of the year. if we get that phase one trade deal in the books, which is anticipated to potentially happen as early as November 15th. TLT, again, we're in a cycle of lowering interest rates, which will gradually drive the rates lower and push the TLT higher. So as long as we think the Fed is going to continue dropping interest rates, then we want to continue holding the TLT in such a large position with a loose option collar. Also, if we still think there's potential risk for earnings to slip, which they might this week, although I doubt it, or for the trade deal to break down, which there's really no reason to think it won't. After 2 years of it breaking down, you'd have to have absolutely no memory to believe that we're completely out of the woods in that front. So because of just those two things, it makes sense to remain long the TLT and weather the volatility. Emerging markets is a trade I really like if we're making progress on a trade deal. But in the same breath, if the trade deal breaks down, I think the emerging markets could sell off actually harder than the SPY, which is fine because if we flip to the inverted option collar, we can still bet down on emerging markets quite easily. GDX is the gold miner ETF, and again, we have all the right elements to be long gold miners. We have number one, period of lowering interest rates, 2, quantitative easing, and then 3, we have potential risks that can create fear in the market. And so most likely that would either be China's growth continuing to slow down, which has gone from something like 9% a year ago to 6% just in the most recent quarter, as well as potential for a slowdown in earnings in the U.S. We have impeachment fears, plus we have the U.S.-China trade deal, which could break down at any point. The dollar has been softening, which is bullish for especially emerging markets, but also gold and stocks. And in our portfolio, we actually took 2% of the gold position and invested 1% in Bitcoin and 1% in Ethereum. It accomplishes the same goal as gold, so if you want to just keep it simple, don't worry about that. But if you want to follow our portfolio exactly, we have done very well being long Bitcoin and Ethereum since December. We have gradually increased our position size in this as the central bank went from being very hawkish, talking about rate hikes and quantitative tightening all of 2018, to completely reversing course and doing what they call the Powell pivot so far this year. One trade setup we've been dying to do but holding back on is to short the Chinese currency. And so we need to see what comes of this potential phase one trade deal. Part of it is supposed to be something to do with controlling the exchange rate of their currency. But the big picture is clearly that the Chinese are devaluing their currency to offset tariff costs. The next time the trade talks do break down and more tariffs get threatened, we want to immediately jump into this trade. And the basic math on this is we can use the futures market to sell their currency at today's price and then buy it in the future. And so for every 10 cents this moves higher, we can potentially generate $1,000 profit per contract. Over in the commodities market, we're keeping a close eye on spot gold. That's very important for our gold miner position. We want to see that price remain healthy so that the gold miners continue to get a bid and start to dig up lots of gold that they can sell for a high profit. Silver, we're closely watching, waiting for this trade deal to either break down to potentially replace our Tuesday trade back into silver. And we watch oil to make sure it's not too low or too high, representing either slow growth if it gets too low or the fear of inflation if it gets too high. So between 50 and 70 is a fair range that doesn't cause concern. In terms of the bond market, the Fed is primarily buying treasuries that are expiration of 1 year or less. So that's not helping out our TLT, but it is pulling a lot of pressure off the bond market and also frees up a lot of capital to, number one, buy the TLT as its yield gets more and more attractive, and then two, for all these big banks to now pump money into the equities market. Here's some of the top content I've pulled out of Twitter. White House advisor Kudlow says if Phase 1 China trade talks go well, December tariffs could be taken off. And so the rumor I'd been seeing was something that the Chinese wanted all tariffs removed to sign this deal. So we'll see what comes of that. Wilbur Ross was on TV this morning and says the deal doesn't have to be in November, it has to be right. And he also goes to say the meat of the deal will be Phase 2 and Phase 3. So this whole timeline is very interesting, especially as we get close to the election. This is a very advanced newsletter I read, but the highlights that are important is Fed is purchasing $60 billion a month of treasuries. And the next screenshot I have is that the ECB is buying $20 billion per month. So this is pulling a lot of pressure off the bond market. It's allowing all these big banks to clear up their balance sheets to be in cash. As far as where to invest if this slowdown were to reverse, especially which it may because of all the quantitative easing happening right now, China's also suspected to roll out some easing in the near future, which always pumps up PMIs and GDPs. But they're seeing strong numbers in Brazil. China's, according to their own stats at least, remains strong, but India, Thailand, Vietnam, all doing very well. So the big question is, will emerging markets outperform the S&P 500 for once in their history? It's been very rare that they have. But we can look at the PEs are at 17.3 versus 13.3. So if you're doing a value play, emerging markets does look very strong. Also, for U.S. equities, a key question is, will the consumer remain strong? And it should. We have very low unemployment. We have slow but steady wage growth. And the government is creating a huge deficit, which will keep those GDP numbers strong. What could go wrong? Well, of course, the China trade deal could go wrong. Earnings this week could be weak. We're seeing earnings slow down, but they're still growing. Kyle Bass is not very happy, I'm sure, with all this talk of a Phase 1 deal. He wants complete decoupling and wants the Chinese companies to submit to real audits. But that's not going to happen because they are extremely secretive. The accounting of the Chinese Communist Party is part of their state secrets, and that's absolutely off the table. So I don't think that will happen unless they are forced to do so. What's the big problem? To me, it seems like the big problem is that the monetary policy of the central banks has led key assets like real estate to rise in value at a faster rate than your average Joe's income has increased. So it's created a tough environment for your common Joe to survive. And even though the CPI that our government puts out would indicate no inflation, we all know that's totally bogus. They alter those to weed out things like college, medical, and rent, and just focus on things that have remained relatively flat in price. So what's the result? We have protests around the world. We have populism around the world. Unrest in Lebanon, Hong Kong, Baghdad, Ecuador, Barcelona, Chile, France. It's a general push that's been squeezing the average Joe for the last decade. Now, why do we want to be long emerging markets? Well, even though the Chinese won't ever let you audit their numbers, here's what is important about what they have put together. So in one breath, their strategy of taxing the labor at 70%, pooling all the money together, and then creating these state objectives, it has some pluses and some minuses. But here's what does stand out. Tencent and Alibaba are ranked among the 10 most valuable publicly traded companies in the world. China has certainly ripped off everything that we have and then gone another step. So they started off just stealing technology, but now they are innovating. So Facebook's ripoff is WeChat and Tatua. Now in China, they don't even use email. They only use WeChat. It's completely dead. They don't have cash. They don't have credit cards. Everything's with QR codes. So they have gone far above us in a lot of ways. They work 6 days a week, not 5. So there's just a general excitement in China that is greater than in the U.S., where we have a lot of freeloaders who sit around and collect free paychecks. The story in China is a lot different. And their Amazon ripoff is Alibaba. Starbucks is now having tough competition with Luckin Coffee. And they have a few products that are going global, like TikTok. That's something like Snapchat and Instagram combined, a Chinese product that's gone viral. And now the state-operated enterprises, which are pooling all their country's funds together, are trying to take over these sectors: 5G, AI, robotics, biotech, space exploration, a shared economy, facial recognition, social credit systems. They have their Belt and Road Initiative. So it's going to be very difficult to compete with the entire GDP of China in these sectors that they're targeting, which is one of the main complaints about this trade deal. And so that is why we do like the position in emerging markets when the two are playing nicely. We have a period of lowering interest rates and quantitative easing. So that's our setup for the foreseeable weeks ahead. Let's see if we have any questions out there. Let me also go through this little. If you have any questions, go ahead and post them down there, guys. And to wrap up today, I'll just go through our little slideshow of what we do for new people who are interested. And also, if you are a member and interested in a lifetime deal, our offer to do that is coming to an end. So we're going to be focusing on annual memberships, as obviously that's much more profitable for our company in the long run. But if you'd like to save, make sure to call Dean. We'll have his number on the screen in a minute. Daily income trade alerts at noon Eastern. Our target return of investment is 1% a month, and we've only had one losing month, although October is down currently. Here again is a look at our return per month. While we don't always outperform the S&P 500, what we don't do typically is lose money when the stock market has a pullback. And so you can see in the December Christmas massacre, we made 1%. Look at May, 7% crash in S&P 500, we made 2.2%. In June, well, the stock market flew up almost 8%. We only made 3.2%. July, we had a loss of 1%. Again, we were positioned in case that critical trade deal broke down. If it had broken down, we would have had a positive return that month, and most equity holders would probably be sitting on a loss at least as bad as May, if not worse. August, the trade deal did break down, and we got that sell-off. We had a 6% sell-off in August, and guess what? We walked away with a 1.8% return. And so now we're back to long equities, as the administration would lead us to believe we have a trade deal in the works. But if it breaks down, we won't be hurt because we have that TLT and GDX plus a put option below the SPY. And again, our goal is income and safety, not growth, speculation, or hopeful thinking. So you can simplify your holdings, reduce your risk, get better results with less work, and weatherproof your retirement portfolio. target return is 1% a month. So if you had $300,000 invested, our goal is to generate a $3,000 per month profit. We do have that lifetime plan in the description box below. So if you do look at the description box, you can apply for our advisory right here or call Dean. Here's what you'll get. Easy to follow daily income trade alerts every Monday through Friday at noon Eastern. A daily 1-hour video teaching you how to place the trade and the thinking behind the trade. That's this video right here. An optional spreadsheet just like ours to track your results with tutorials on how to use it. The promise to protect your portfolio and pick up the low-hanging fruit for a target return of 1% per month. And we also have a bonus when you get a lifetime deal to have access to part of the Retirement Income Bootcamp. It's a 16-week bootcamp that turns you into an options trading machine that can print safe profits out of the stock and bond market. It's a webinar every Monday and Tuesday. Monday is Q&A. Tuesday is a lecture with a resource email and quiz. This is recorded, so you can watch it over and over again as many times as you need. And call Dean at 505-322-7515. We still have one spot left for our lifetime deal, and we'd love to get you involved in it. So call him now, 505-322-7515. I'll leave the disclaimer up and see if we have any questions out there. Ron, thanks for joining us live. And Tom, how's it going? All right, guys, thank you so much for your time. Tuesday is our next trade, which is emerging markets. We're up substantially on that play, and I think we'll have pretty consistent wins on our equities plays leading up to that November 15th key event. So thank you so much for your time, and look forward to a new trade alert tomorrow.